Investing in index funds, easy and beginner friendly. One of the most important things we need to understand about money is that it only grows if we risk it. This does not mean gambling or wasting money on useless expenses. A wise and efficient way to grow money is by investing it. And one of the best equities to invest in are index funds. Today, we are going to talk about the basics of investing in index funds, how to evaluate a good fund to invest in, and the actual steps in buying. We will be detail-oriented and elaborate on the concepts related to index funds to further deepen your knowledge and boost your confidence in investing. Make sure you stay until the end of the video, because we will be showing you the actual process of investing in index funds on the Charles Schwab site. This way, you will be familiar with the Charles Schwab platform as well. Hi, welcome to RCA Finance Guide, where we'll be talking about the topics of handling finances and making money. This channel will definitely help you start your dream to be financially literate. We will upload videos to the channel for your watching pleasure 3 to 4 times per week. If you have any feedback and questions about this video or want topics you would like to see, make sure to comment them down below. Also, make sure to press the subscribe button and hit the notification bell to be updated in all of our latest videos. Let's go through the basics very quickly. What are index funds? Index funds are baskets of stock designed to replicate or track a specific market index. These are passively managed and have low expense ratios or fees. Compared to actively managed funds, they match the risk and return of the overall index. Examples are S&P 500, DJIA, Russell 2000. There are over 2,500 plus index funds that exist. These are just the general type. Number 1, broad market. Example is Vanguard Total Index Fund. 2, market cap index funds, large, mid, or small. Number 3, equal weight. Example is Nifty 50. 4, factor-based. 5, sector-based. It includes banking, technology. Number 6, international index funds, which, as the name implies, are based overseas. 7, debt, which includes bonds. With a large variety of index funds available, how do we know which ones are good? One of the most basic things to check if an index fund is good is to know how much they cost. A quick way to check this is to look at expense ratio, which is the total fees per total investment. Example, if you invest $100,000 and the expense ratio is 0.03%, you spend $30 a year on this investment. A good expense ratio is 0.35% or less. Great ones are 0.1% or less. Now, the next thing we'll look at is risk. Investing in general is risky, which is why investors are compensated for the risk they take. When it comes to index funds, here are some of the risks you need to know. Number 1, there will be rises and falls with the index. 2, no downside protection, as there is no portfolio manager to protect or make decisions to react to market changes. Number 3, can't take advantage of opportunity. As mentioned, it's a fixed set of shares. New, up and coming investment opportunities are not going to be magically included. Number 4, doesn't cut the losers. Just means that shares in the portfolio that are not performing well remains in the portfolio. Number 5, no portfolio management. We have gone through the concepts related to index funds, including expense ratios and risks. Do you have any questions or clarifications so far? Please tell us in the comments section below. Also, if you like this video, please give it a thumbs up. Now that we have covered some of the basics, let's go over the steps in investing in index funds. First thing you need to do is to pick an index or multiple indices you want to invest in. Think of this like a pie. You need to divide your investments wisely among different types of stocks. You can look at large cap index funds, small cap index funds, international, or bonds depending on what you're interested in. A good way to divide is to assign weights like 50%, 15%, 15%, and 20%. For example, you can divide your money like this: 50% large cap, 15% small cap, 15% international, and 20% bonds. Quick side note, if you do not know what a large cap, small cap, and bonds are, please check out our video titled Stock Market for Beginners. It'll provide a great foundation to help you grasp these concepts easily. Number 2, now that you have an idea which index or sets of indices you like, it's a matter of selecting a good fund or platform. This is where you need to ask the right questions. A. Which fund has the best expense ratio? Remember, the usual ratio is 0.35, but the best ones are only around 0.1% or less. B. Where do I get quality information about these funds? Quick answer, go to ETF.com and read. You can read about different index funds and check it for yourself. ETF.com will provide all the pertinent information to help you assess whether a certain index fund is right for you or not. C. Next important concern, do you have overlap between indices? Investing in multiple index funds may lead to overlap, so your portfolio becomes inefficient and does not have enough diversification. To check this, you can use the site etfrc.com, which allows you to compare two index funds in terms of overlap or similarities. You'll be able to see overlap by weight, which provides a direct illustration if it's good to invest in both or not. The next part of the video is about the actual steps in investing in index funds. If you have any prior experience with this type of investment, please share us in the comments section below. If you have other videos you would like to see on the channel, do not hesitate to make suggestions in the comments section as well. Now, let's proceed to the actual steps to buy an index fund. This can be done through various brokerages like Robinhood or Charles Schwab. Just proceed to trade, then search for the symbol equivalent to the particular index fund you are interested in. Once you have searched it, you will be able to see the price per share. Just click Buy, select one, Share, then select Order type as Market Order or Limit Order. Market order means you will buy the share at the current price. Limit order means you will set a target price and the sale only proceeds if the target price you set is reached. Afterwards, you may review the order, which shows you a summary of the transaction. Then click Buy and you are done. Overall, it's simple and easy to start. Understand what you want to invest in, then buy the index funds that tracks the set of shares you are interested in. We have covered so much in the video. We hope you found this useful and informative. If you are still a bit confused about other terms, please check out other video, Stock Market for Beginners, as it covers other basic terms that are truly helpful. As always, please do not forget to like, subscribe, and turn on notifications so that you will be notified when we drop our next video. Take care.